How about now on the microphone? It wants to default to the wrong thing. How about now? Can you hear me now? Okay. All right. Before we have any problems, we're going to go straight for this. Okay. All right. So Nathan, here's what I would tell you. Robert Kiyosaki, Dave Ramsey, Susie Orman, they're all financial entertainers. And that's the simple truth is Robert Kiyosaki, you know, I don't want to say he's losing influence, but it's, you know, I mean, these guys got to stay in the, I mean, it's like Susie Orman. I guess she made enough money that she doesn't have to be front and center anymore. Dave Ramsey's still doing his show and stuff, but like, they're financial entertainers. So they say things that are shocking or whatever. Do I believe in the stock market, putting money in the stock? I believe in putting the money in the stock market if you have a strategy. But most people don't have a strategy and they just put money in there and they put it in a mutual fund. They have no idea what the mutual fund's holdings are. And then everything about Wall Street is manipulative. There's nobody that can tell you why it's doing what it's doing. I mean, there's certain indicators, but there are times where the market does things that they don't expect, or everybody would be making a ton of money, right? And I mean, like, there would be somebody out there going, oh, here's the secret. Now, there are secrets, there are patterns, and it used to be this old thing with the movie theaters stock. You could buy certain times of the year, you knew it was going to be down, then they would come out the blockbusters, then it would go up. And you could get in when you're supposed to, get out when you're supposed to, and you could make money. You got to have a system. So like just putting your money in a mutual fund or a 401k and just hoping that it goes up. But then they're going to lie to you about how much it's going up. Average versus actual, all of those things that are in the courses that we have on the community, is all of it makes to where the game is rigged against you. And so why do people put money in it? Why do people put money in those things? There's a study, I think it was called like the ASH study or something like that. It was at Harvard, and they had, and I'm sure Heather knows what I'm going to say here. And I'm probably going to butcher this, Heather, but you're going to get you're going to get the idea. There were 4 lines on this chalkboard. And one line was like clearly longer than the other lines. And so it was A, B, C, D. And so they would bring people in, but there were 3 people that were in on the study. And what they would ask these 4 people, which line is the longest? Now remember, A, B, and C are the exact same length, and D is longer. The other people would go first, and they would all say A. And then the person that was the actual person, that was the honest person, not the setup in this, they would get hesitant. And like 70% of those people, something like that, again, this is where I'm butchering it, 70% of those people would say, okay, yeah, A is longer, when they clearly knew A was not longer. And what's all the psychology behind that? We'll have to have Heather do the next meeting and explain all of that. But it's people wanting to conform. It's like this, there's other psychological reasons, but in our world, in the community, et cetera, it's because people want to conform. So they put money in a 401k. They have no idea how much it's going to be taxed when they take it out. If they wanted to use it, if they have all these great opportunities or emergencies, they can't use their money without penalty and tax. Tax at what rate? Who knows? So you're giving up the use of good dollars that are worth more now because they're not being inflated yet. They haven't been debased, for dollars that are going to be debased, that are going to be worth less in the future, and taxed at a rate that they won't tell you what they're going to tax it at. So am I against the stock market from that? Yes. Am I against the stock market of somebody just putting their money in Edward Jones and paying somebody a fee to buy American funds for them, because that's basically what Edward Jones does? Yes, I'm against that. Because I think you're being manipulated. I think you're being lied to. And and Heather says 75% of the people went along with the other three. That's crazy. But I mean, I tell people this every day. People will stand in the reassuring lie line, even if you tell them it's a reassuring lie. They'll stand there because everybody else is in that line. And people go, well, people don't really do that, do they? Yes. It's crazy. It's so sad. So we have to break out of it. You know what? And Heather, maybe what we'll do is we'll do a live maybe in the next couple of weeks about this and like the conformity and why people do that. There's other studies that talk about that. And there's one, I mean, with money, again, people go, well, if we're all going down, we're all going down together. So to go back to, and then Dwayne asked about precious metals. Everything is a good investment for timing. Timing's everything. But let's go back to the richest man in Babylon and to Nathan and to Dwayne and anybody else is one of the tenants in the richest man in Babylon. And remember, the setting is that he's got him and his friends, and he's got more money than his friends. And they're like, hey, you make about the same amount of money as we do. You have the same amount of expenses, everything else, but you have more money than us. Why? And he goes through these reasons why he has more money than them. One of the things that he says is invest in what you know. Are precious metals a great Are precious metals a great investment? They can be for the person that knows what they're doing. But to give your money to somebody and hope that that person knows what they're doing, and hopes that they don't take your money, or hope that they're not asleep at the switch when it's time to buy or sell, that's a lot riskier, right? Do I think gold and silver are going to go up over time? Yes. Are they going to go down, up and down? Yes, but overall they'll go up, right? But it's just your timing. So like if you are one of those people that is on the track of retiring, right? You believe in retirement, which means you're going to build up this money over 20, 30, 40 years, and then you're going to have this lump sum that you're going to live off for the rest of your life and hope that you don't run out of money. If that's what you're going to do, then you better hope that when you pull that switch or turn that switch on, that you're not unlucky with sequence of returns. So sequence of returns is, what's it going to do that first year that you're retired? If it goes up 15%, good for you. If it goes down 15%, you just killed off 15% of your workers, because now remember, your money are your workers. You're not going and exchanging time for money anymore. Those are your workers. And if you kill off 15% of them, and you were going to systematically live off the interest, you just took a 15% cut. And it's worse than that if I went through the math and drew it out for you. You're in trouble. You cannot then take out the same amount that you were going to take out. You can't. And if it goes up 15%, it goes up 15% again, maybe you can take out more. But you're in trouble a little bit there. So and Glenn said, don't be afraid to capitalize, and your cash is available and you can go do whatever you want to with it, and cash is liquid. Absolutely. So one of the great things, and that's one of the things that I'm going to talk about today, and I'll kind of transition. I hope that answered the questions. But like, how are you going to fund your big ideas using infinite banking? concept, right? I mean, how are you going to do it? And so I'm just going to walk you through quickly kind of the steps. The first thing, I know this is going to sound really basic and silly in the beginning, but the first thing is understand what IBC is. Okay, it's not an insurance policy, although you need an insurance policy to do it. It's a process. You're not going to actually open your own bank where you're going to, but you're going to act like a banker, right? It's a strategy where you use a whole life policy in your personal banking system. And you can borrow against that cash value and buy income generating assets. Okay, why would you want your assets to generate income? Because then you don't have to go work or exchange time for that, right? So what's the difference between doing that and having a traditional bank? Flexibility, taxes, control, and you're having compounding, uninterrupted compounding growth. So that's the first thing. So then you do have to buy an insurance contract. Well, you got to find a reputable insurance company that doesn't hate infinite banking. Because again, why would they hate it? Jim, if this is so good, why would the insurance company hate it? Because they're a large financial institution. What do large financial institutions want? Your money. How much of it do they want? All of it. How long do they want to keep it? Forever. How much do they want to give back to you? None, or as little as possible. All of them. So that's why somebody wouldn't like it. Okay, and then so you got to get the right insurance company. Then you got to get the right IBC coach, because if somebody's only been doing this 5 years and they haven't seen the ups and downs, or somebody make a mistake on an asset they buy, and how do you get out of that? How do you build your way back? What if I don't have the money to capitalize in the third year because I forgot I was going to do this and I went and put my money? All of these things that can come up, right? And if you've been a brain surgeon for 20 years, then you know more than if you've been a brain surgeon for 2 years. You've seen more scenarios. So you got to find the right coach that's going to guide you through even the application process, and knowing that you have the right benefits and everything in the policy, right? And then once you fund the policy, to Glenn's point, don't be afraid to capitalize. That's what Nelson said. Don't be afraid to capitalize. You're going to build cash value. Now we're going to sometimes we put a ton of money in there and we can start using it right away. And there is no reason to build, or we can start using it even if there's a modest amount of money in there. We can use it for smaller things until we're ready to go buy cash flowing assets. So either way, whether you have it in there or you have to wait for accumulation, you at least within a few years, you're ready, and your policy is you're ready to use the policy and leverage it. Understand dividends, understand loans, understand all of those things, or have somebody that you can educate you on that. So then what you're going to do, once you've got this system in your head, you know what's happening, you know how it flows, you have the policy or policies in place, you found an investment, back to Dwayne's question, like in the precious metals, is you have something that you want to invest in that you're going to go buy an asset, right? You're going to go buy precious metals, real estate, a business, a building, whatever it is. You're going to request a policy loan. That's pretty easy. Some companies take weeks to give you a loan. We could have you, not still today, but like if you called 8 o'clock this morning, we could have you a loan processed and wired to you today. So you want to make sure, just things like that, you never know. So then figure out how much, so you're not stealing the peas. You're gonna your interest rate, your repayment, all of that, right? Do you have to repay it? You don't. You're the bank. You're in control. But we can tell you, and that's where your coach comes in. What are the different strategies? Why would I pay it back? Why wouldn't I pay it back? Should I wait till the asset is cash flowing? All of those things we've been through a million times. So then you got to find opportunities to go put your money in, right? Cash flowing assets. But one of the things that's nice about when you buy cash flowing assets like real estate, and let's say it's commercial or you're buying a real estate portfolio, you can see what it's doing. You get to see the books. So you know, okay, I'm going to take this loan. I'm going to pay this much back to the loan. This is what the real estate business, because everything is a business, is making, and this is how much I'm going to keep, right? And here's my contingencies for any emergencies, right? So then you say, this is what I want to buy, but I could buy real estate. I could buy dividend paying stocks if I have a system and I know. I could buy businesses, okay? I bought all of those things using my phone banking system. But one of the most important things is I did my due diligence. You got to evaluate those investments and cash flow projections, return on investment, risks involved. You know, I mean, in Florida, if you own a bunch of real estate and now you can't get insurance, that's a big problem. That's a big risk, right? If you had variable interest rate and you only had 5 years fixed, and then now it's going to go from 3% to 7%, those are all problems. So once you identify what it is, you've done your due diligence and you're like, hey, this is a good deal, then you use that loan to invest. Could be the down payment, and then the seller's going to finance the rest of it. Could be the whole purchase price. Could be, I'm going to put the down payment through this. Could be I go to the bank and they say, well, we'll give you a loan based on the renovated value of the property, but you got to show us where you have liquidity to do the renovations. This happens every day. Well, maybe not every day, but all the time. So you go, well, I got it all right here in my insurance contract, and I've requested a loan to start the renovations. Boom, right? So now that's even better because they're going to give you a loan on the bigger amount. You're going to go do the renovations. It's going to be worth that amount. You can pay back the loan, everything else. Okay, so once you start to do, you got this up and running, right? You have to manage those investments. Okay, this is something that gets in people's heads. But you got to track performance. You know, is your cash flow working the same? You know, I was going to buy this car wash one time, and it was during all the COVID crap, and the guy tried to put the PPP money in there. And then I said, well, wait a minute, that doesn't count. I mean, I'm not going to be able to recreate that. That's not going to happen. So you got to monitor your cash flow and how is that working? And then you got to repay the loan, the policy loan. You don't have to, but as Nelson said, you're stealing the peas, right? Because that's going to replenish the cash value and prepares you for future loans. So we want to have velocity of money where we're borrowing, growing this portfolio. Everybody wants the portfolio that's producing $1 million a year of passive income, but you got to take the action to get there. Everybody wants to have the abs, but you got to work your abs to actually get it, and you got to cut down whatever you're eating, right? So we have a system. We bought this real estate, we put 20% down, or we had the bank do the stuff and for the renovation, whatever we did. It starts to come back in, we're tracking it, looks good. So what do? Rinse and repeat, continue the cycle. As that money comes back in, don't go buy, a Ferrari or something or a truck. Wait until you got enough money to go do another deal, because now we're buying assets. Remember before, they were telling us, take our money, live off of these, make our money our workers. Now our assets are our workers, okay? I can't insure my stock market account. I can my apartment complex, and I can have in that apartment complex, I can have 100 residents. So if one moves out, it's not that big a deal. All right, so remember, we're going to reinvest that cash. It's going to come back in. We're going to reinvest it. That's what a bank does. Takes your mortgage payment, my mortgage payment, everybody's mortgage payment, pulls it together and loans it out again, because they're stacking, right? All that money, it just increases your cash flow. So as you leverage your cash again, you do it again and again and again and again and again until you have more money coming in than you need for your ideal standard of living. And then you're what? Financially independent, financially free. And you're financially free, not so you can sit around and play golf 6 days a week or go fishing 6 days a week or whatever you like to do. In my mind, I still want to be of service to others. So you're going to go do what you want to do when you want to do it, right? I mean, again, if you wanted to play golf 6 days a week, if your back can handle it, I know mine couldn't, but you get to do what you want to do. But in my opinion, I think we're called to help other people and serve other people. And so maybe you're just volunteering your time. Maybe you're coaching other people how to do this, right? So when you work with an IBC coach, you got to have regular check-ins, right? What's going on? Here's what I did with the money. Here's how that's working. Any guidance or things like that, any strategies or adjustments that you think I should make. Sometimes those are quick meetings, because if I'm educating myself about it, like in the very beginning, Nelson would say this is incredibly simple. So once you kind of get it down, you probably already know some of those answers. And then I think this is a key, is it's like stay informed, is we are constantly learning and seeing how other people are using infinite banking. Not just how we are, but how our clients are. So hey, did you ever think about this? I know you're a dentist. This other person that was a dentist, they started using it for their operatories. And because we have those resources, we can help guide you and help you keep you on track of building more and more and more of your infinite banking system. But if you follow those steps, you got the right coach, then you're going to achieve as big ideas as you have. It's just a matter of like leverage, compounding, and turns. Every business is based on turns. The more turns creates velocity of money. Any engineers out there, not velocity like in science, but velocity of money, moving faster and faster and faster. And it's just a matter of time until you build it up to where you have the system that you want. So exactly, Dwayne, the grocery store theory, right? That grocery store, you either get the grocery store or you don't. And there's a point where some people just won't like get why you would pay for your groceries if you own the grocery store. But Glenn says currently working on a $4 million loan. They need a liquidity statement. I've never seen one bank in the world that doesn't give you a 100% credit for whole life insurance cash values. Universal life, they'll give you 70-ish% because they know you can go up and down and et cetera. They know with whole life you can't lose it, right? You can take more risk when you have the cash available. Absolutely. And it's educated risk, right? I mean, we take a risk when we get in our car and go down the street, but your car has airbags, and you know every car that you see that's coming out into the street that you're driving on, I assume everybody's going to pull out in front of me. So I'm ready to stop, right? I mean, you're cautious, not reckless risk. It's educated risk. So then I agree with that, Glenn. You take educated risk. Matt says, I'm on board to get started. First year premium paid. Next step based on today's talk. Next step, identify what you're going to do with the money that's in your policy. In the beginning, if it's your first premium and it's a modest amount that you put in, maybe it's taking over some debt. We're going to get rid of that debt while we're going out and educating ourselves on what assets to buy. Or I'm going to go take a course on assets, or I'm going to find somebody that that will do it for me. You can do it passively, depending on how much money you have in there. So that's the next step. But getting the system down, and I would continually educate myself on infinite banking. I was on the David Stern's podcast the other day with his daughter, Lee. And he said, Jim, I remember when Nelson told me about you, and he said, this guy's reading every book on our website. And so Nelson, I told Nelson, I've read every book on IBC that's been produced at the time. And I did, all the good ones, all the bad ones. I educated myself on everything that I could find. And I would go, and you know what's so funny is I'd go, no, that's not how it works. Like some of them were that bad. They were explaining infinite banking the wrong way. So I would use Nelson's book as the standard, that if it conflicted with Nelson's book, then I'd call Nelson. I would ask him. But I educated myself on every book continually now after 20 some years of infinite banking and 37 years or 38 years, I think I'm in my 38th year of being in the financial services world, continue to educate myself every day. And so that's what I would do, is I would continue to educate myself every day. I would get all of this stuff down, but I also just, like I have 2 trainers. Like I know what I'm supposed to do now, but I still like to have the trainer say, hey, flex those lats before you do pull downs, or hey, on your hanging abs, get those knees a little higher. Like check me, right? And so it's the same way in doing this, is you need that coach if you want to get the best results. And so to Matt's point last week, if you're going to keep the abs, you gotta keep having the coach. And Nick and I just recorded literally an hour and a half ago things that high producing people do, right? The same thing we did last week on the live, but then we did a podcast version of it. And it was assess where you're at and make adjustments. So 6 months ago, I said I got 2 problems: the food I'm eating, and I'm not getting the results working out in the gym with the trainer that I want. I want to put on more muscle. I feel like at 59, then like I only have so much time to put on muscle. So I want to put on as much muscle as I can. I wasn't doing it there. So I changed trainers. That trainer does all my food prep now. So now I'm getting leaner, putting on more muscle, making that adjustment. If I would have just sat there and go, well, I'm going to a good trainer, they're really good, and the food is what the food is, then I wouldn't get the results. I was happy that I was making progress, but I wanted to do something bigger. And so in 6 months, I might decide to make another change, but always moving forward, always making progress. Sorry, I've gone way over our normal 20, 25 minutes, but I hope this was helpful, because I love the questions in the beginning. And so I'll read this last thing real quick. After my first premium, I got a loan to assist with a rehab on a property I purchased, which I'm now paying back in monthly payments. Now that I've paid my second premium, is there more money available to borrow, even I'm currently paying back the last loan? Absolutely. If you just paid your new premium, you're going to have 90% or more of what you put in that second year to borrow out again and do another rehab or do more. That's the whole thing, because now you're earning money on that first loan, then the second loan, and then play it forward. As those loans are coming back, you're loaning that money out the second time, plus you're putting more capitalization in, you're loaning that money out, and this thing just starts to just leverage, and I don't want to say explode, but it just starts to make progress like a mushroom cloud. It just gets bigger and bigger and bigger and bigger. So yeah, great job. And thank you, Angela. You can build muscle at any age. And I totally agree with that. It's so funny. Last thing is I play golf with all these guys and they're like, God, you're hitting the ball so far. You're like, it's because you're putting on that muscle or whatever. I'm like, I go to the gym 6 days a week. So it's like, you want to hit the golf ball further, then go to the gym 6 days a week. I don't know what else to tell you, right? But it's a journey, and it's like you learn those habits. And I learned the alarm went off at 4:30 this morning. I got up because I know if I argue, I got up and I made my bed. Back to the Admiral, make your bed comment. Why do I make my bed? Because that's one accomplishment every day. First thing, right? Make your bed. Okay, I've accomplished something. Win, check, right? Had some coffee. That's a win for me. Anyway, thank you all for hanging in there as we've gone way over the time. And we'll see you next week. And Godspeed. Everybody have a great week.